Hey, everybody, and welcome back to the Teaching Tax Flow podcast, episode 162. We are going to dive into the section 179 deduction. So, if you don't know what it is, hang tight. You're about to find out, but not before a brief moment to thank our episode sponsor.
This podcast is brought to you by Legacy Lock. If you are new to estate planning or simply need to review your current plan, Legacy Lock makes it as easy as pie. Legacy Lock is a unique platform that enables you to easily complete your attorney-drafted documents conveniently from the comfort of your home or office. Your first step to this peace of mind is simply visiting teachingtaxflow.com/legacy.
All right, everyone, you're back here again on the Teaching Tax Flow podcast, as you heard here in the beginning. So we're going to look at that section 179. So sure, you've probably heard this thing, or maybe you haven't, but you're about to. Actually, you just did. So you're about to hear what it is. And this is one of those things where I don't know if there's a lot of confusion around it, or if there's just people know what it is, but they don't. I wouldn't say they don't really care. They think it might not apply to them. So trust me, you don't want to hear it from me. Even though I have more hair on my chin than my co-host has on his head, that does not mean that I have more knowledge. He's way smarter and better looking. So, Chris Pacuro, welcome back, man. Let's dive into this one, eh?
Excited to dive in. I talk about section 179. I just came off a grueling 2-week road trip recently, teaching tax season updates for the National Association of Tax Professionals. I love meeting with tax professionals all over the country, John. We got to go to Boise, Idaho. Where did I go? Denver, Colorado. Got to teach right here in the gorgeous state of Tennessee. And my favorite tax season update location, I've done this for 3 years, Albuquerque, New Mexico. Believe it or not, that has been my favorite place over the last few years. Awesome people. We actually have a fellow tax professional that lives there, so I was able to catch up with him. Why am I talking about all this globetrotting? Because in the globetrotting, I kind of came up with this way of explaining section 179 to tax professionals, and I think we can all understand it. It's the cousin of bonus depreciation. So bonus depreciation, we have some content on that. When you buy a eligible fixed asset, a business gets an immediate tax deduction, but you have to elect out of it. So you just get it if you like it or not, or elect out of it. Section 179, if you have eligible property, you can get it, but you have to elect into it. So you've got to raise your hand and say, hey, I want section 179. Now, section 179 and bonus depreciation can be used in concert together. So we're going to dive into what that is, because a lot of times people are talking about section 179 and they have no idea what the heck they're talking about. Or they don't, well, half the time they don't know what they're talking about, but they don't realize they're talking about it. So like, John, section 280 AG, huh? Oh, the Augusta rule. So people are talking, well, can't I rent this? Can't I rent my house for my business so my dog could, do that? Like, no, don't misapply. Ideas are cheap, implementation's valuable. So a lot of people in the teaching tax flow community, thank you to everyone in the Defeating Taxes private Facebook group. You are the really driver in a lot of these topics. And so they'll say, hey, if I buy a new vehicle, if I buy a piece of machinery, do I get a deduction? So let's dive in. Section 179. Now, this has been around for a long time, as long as I've been practicing, so over 20 years. However, one big, beautiful bill act, as we've come to know and love it, OB3. I always said, in teaching those classes, I'm a big Star Wars lover, so I like OB3. We got Obi-Wan Kenobi and C-3PO. If they had a baby, ooh, that wouldn't be pretty, John. But it would be called OB3.
You know what's awesome, though, is like, we kind of jokingly talk about that as, it's the cousin of bonus, but I think that's a great way to explain it, right? And I would say this to anybody that, I don't, and this is going to come out wrong, but I'm going to say it anyways. So just knowing that it's going to happen. I think the assumption that people are kind of, I'd say that they kind of inherit, maybe is the word, as a taxpayer, and that you have a tax person. I am using the air quotes person doing things for them. I think we just kind of say, oh, well, they got this. But I'm glad that you mentioned that some things, case in point, you have to opt in, opt out of. It just doesn't automatically happen, right? Like if you're doing your own, like say you go the DIY route, you think, again, air quotes, you have a simple tax return, because we know that doesn't exist. the IRS is never gonna call you, right, and say, "Oh, you missed this. You may want to elect for this or elect out of." It's never gonna happen. So we talk about complexity. This is a perfect scenario where you really have to know what plays with what and how and opt in, opt outs, all of that, right?
Right, and the nice thing with Section 179 now, let's for bonus depreciation, you get it or you can elect out of it by asset class, but it's an all or nothing proposition. With 179, you can elect into it, and you can elect into it for the exact dollar amount that you want. So it's almost like Play-Doh, right? It's a Play-Doh deduction. You can mold it into what you want. Sometimes you don't want to take all of it. Sometimes you want to leave some for later. So yeah, Section 179, it allows businesses to immediately expense qualifying property in the year it's placed into service. Now that's very important, taxpayers, especially as we roll into this end of year. If John, you bought a piece of equipment, let's say you were back doing your general contracting stuff, woodworking and that sort of stuff, and you said, "Man, I really need a new lathe." Okay, you go put down a $10,000 deposit, but you don't take um, delivery of the lathe until January 13th. That is not placed into service until the next year. So you haven't just because you put a deposit on a vehicle or piece of equipment doesn't mean you placed it into service. Placed it into service means it is being used and available, and that's a very important distinction. It
I think I'm more impressed that you know what the heck a lathe is, sir. I did
Hey,
not
I
know
told
this
I'm
about
old
you.
enough that we had to take home economics in middle school and shop. So
Dude,
we had
I
wood
was in
shop,
shop
metal shop.
classes, careful. They need to bring that back
They
as a matter
should.
of fact. They should if yeah. I mean, who cares if you're missing a couple fingers by the time you graduate? It builds character,
Oh god, yeah,
right?
I think our shop teacher, the guy whose name was Mr. Mitch, I think he almost had a stroke every time we broke off the sander. You know, you'd hit that button. It was like going to the grocery store when you had the conveyor belt that
So
yeah, but
and
anyway,
Chris,
so yeah,
I
so
mean, and back to this. So you bring up another really good point, right?
mhm,
So and you know, obviously we're both from the Detroit area, right? So and I think automakers and dealerships do a really good job of this, right? Because they're not really pushing year end come buy a car, they're doing pre-holiday stuff. Because if they don't have it on the lot, you can order the darn thing. You can put the deposit on it, but until that sucker's rolling down the road with your temp tag or your license plate on it, it's not yours, frankly. So it doesn't matter. And I don't know where I heard this one, right? And it might I wouldn't even say who it is because I can't remember. It has something to do with, like, purchasing a jet. I mean, the extreme, right? And they're like, "Nope, I need it this year." Well, as you know, you're not gonna go to most jet manufacturers. And they say, "Oh, yeah, take this one off the lot. Here you go. It's December 15th." So you mentioned that with equipment, and that's a great example, right? Something that even if you're using it in, like cars, trucks, what are some of the other things that this applies to? Is there anything that you guys see a lot in the private practice world?
yeah, so well, it is the Section 179 is designed to incentivize small to medium sized businesses to buy capital assets. Before we dive into what are the eligible asset types, I want to remind people one of the three laws of teaching tax flow is that cash flow and tax flow are different items. So if you buy that lathe, John, if you pay cash for the whole thing or you finance 99% of it, the deduction is the same. The depreciation schedule is the same. So there is a big distinction, and that's something that could be very confusing. So let's move into the maximum deduction. Then we're going to talk about eligible property.
Perfect.
With OB3, the maximum Section 179 deduction was raised to $2.5 million. So it's a huge amount of immediate deduction a business can take. And here's the nice thing it's indexed for inflation. So it's on Santa's good list. Sometimes we get these things that are not indexed for inflation. I'll give you an example. Capital loss carry forward has been 3,000, capital loss deduction has been $3,000 for Mary Joint forever. It never got indexed for inflation. And the so those are things. So this is indexed for inflation. Now, if a business invests more than $4 million in a year, then you start losing that $2.5 million maximum deduction. So that's called a phase out. Now, the vast majority of taxpayers that take Section 179 purchase much less than $4 million worth of assets. But there is a dollar for dollar reduction at that $4 million of total assets. So this is important, John. Let's say you are a contractor. Let's say you are a roofing company and you are increasing your fleet of trucks on the road. You might want to, if you're getting close to a $4 million of new trucks or new equipment, you might want to stagger that. You might not want to take delivery until the next year, because then you could phase out your Section 179 deduction. So
So
they're
here's a
cool.
curveball question for you actually, and this is an honest to God, scenario that I'm thinking of, and tell me if save it for later. So obviously, I live in somewhat of a rural area next to a city. There was actually a guy I know who mentioned something about this years ago. So, agriculture equipment, some of it's extremely expensive. Like if you think Ferraris are expensive, go try to run a high yield farm, I guess. And I remember him, I don't know what the dollar amount was, but I remember him saying it was like drastically high. I mean, I'm guessing probably like 8 million bucks or something. So he had some, and tell me if this applies. So say you lease something and then you buy out a lease. Is
Mhm.
it still considered the same thing, or would that be a way to maybe stagger it?
It depends.
Okay.
Depends if it's
And
a
that's
capital lease or operating lease. Some
okay.
technical leases are considered capital leases for tax purposes. So a lot of those are like our friends that are long haul truckers. They actually lease the trucks, but it's with a 5-year lease with a dollar buyout. That's considered, it's legally a lease. However, it's technically, from a tax perspective, a capital lease and you depreciate it. So it really depends on the facts and
Gotcha.
circumstances.
Okay. No,
Yeah.
no, that's a, and I thought of that when I'm like, hey, maybe that would be a way to stagger some things if it's not, one item, if it's multiple. But
Right.
awesome. No, that's a great example, even better than mine with the truckers. Like you see most of them that I've ever known have done that.
Oh, for sure. You've got to just plan around things. So what's out? So in now permanently eligible are HVAC systems, roofs, security systems, fire alarms. Those things are available on commercial property for Section 179. So any tangible personal properties like off the shelf software, QIP. So that's qualified improvement property for non-residential real estate. So that means, John, this helped out a ton. I'll give you an example. Think about a restaurant. So you got a restaurant that leases the property to do a restaurant. It's probably a million and a half dollars of kitchen equipment and build out. Now that's all
Yeah.
eligible. That is 179 eligible property.
And it
Now,
wasn't
should they take
before?
all that deduction year one because maybe they don't need it all? Probably not. But maybe they want to take a portion of it, if that makes sense.
Interesting, and you're right, man. I'm knowing people that have owned restaurants. I mean, you too. You basically you rent or lease the vanilla envelope, right?
Hmm.
So you are getting a box, and
Right.
you got to put everything in it, and that is kitchen equipment. Yeah, there's a reason why they repo that stuff. They just don't let it go if you don't
No,
stop.
it's very valuable, which ties into this. It doesn't have to be new equipment. It could be new or used equipment, assuming it's not from a related party. So if you're starting a restaurant and a restaurant down the street went out of business and they've got, these are super expensive, like a fryer hood or something that you could take out of their box, like you say, the restaurant, and put it into yours, or maybe it could be anything, then that's eligible for Section 179. However, it has to be used more than 50% for business, and that's where things get sticky when we're talking about vehicles. But we're gonna run through some short case studies. So who's out? So those are the assets that are eligible. That's what we call eligible property. Now, who's eligible? Pretty much all businesses, S corps, C corps, partnerships, or LLCs, taxed as partnerships, and sole proprietors. But here's the situation. The deduction is elected on the entity level, but it passes through to owners when you have a pass-through entity like an S corp or a multi-member LLC. So, John, if you and I formed a multi-member LLC, and let's say we wanted to mine Bitcoin and we
Okay,
bought $100,000 worth of computer equipment, we could the LLC would elect the Section 179, and then we would get that reflected on my K1 and your K1. You can't get your K1 and say, "Well, I'm electing Section 179 on my half." And so that's the
gotcha.
important thing. So if you're a business owner and you have an S corp or taxed as a partnership or taxed as a C corp, even though, well, let's take C corp out, even though that deduction ultimately flows on your personal tax return, it's made at the entity level. And be very aware, because a lot of states don't allow for bonus depreciation, but do allow for Section 179. So maybe a California, because we like to talk about them a lot. California doesn't allow bonus depreciation, but allows Section 179. So if I've got a client that's in California, a business owner, I might elect out of bonus and elect into 179. So this is where
Mhm.
planning comes into play with your tax professional.
And when you say planning too, just so if I heard you right there, just to kind of reiterate it. So you said if we were partners in a multi-member LLC,
Right.
the decision to elect is made at the entity level. So it c you can't elect and me not, in theory, right? Like,
Right.
it comes down, there's like you said, okay, so that decision being made there is final, not final, but hopefully we talk enough to make the decision together, but,
Yeah.
it doesn't always happen.
It's made at the entity level, and that's where operating agreements could be important, because we want to make sure that we know who has the authority to make those tax matter decisions. And maybe you can't use the bonus depreciation or the Section 179, and maybe I can, because owners apply their limits based on their share of the taxable business income. So again, you might be in 3 different S corps. You might be in 3 different partnerships. So sometimes, you definitely have to do that planning when you're buying fixed assets. But one thing to give people some peace of mind. This election, although you plan your fixed asset purchases before the end of the year, the election is made on a timely filed tax return. So we don't have to decide today what our 2025 Section 179 deduction is. We can decide when we prepare the tax return in 2026.
And I feel like this episode, Chris, and I mean this wholeheartedly, I feel like this may be one of the best ones that we've done, maybe through all of our episodes, or if not, in at least the past 20 or 30, that really gives a very abbreviated but a behind the scenes view of how tax planning actually works, and not just us saying like, "Hey, you need to do this." Like, this is a fantastic example, right? Because even if you're in, well, here, let's be honest, right? And I will be very transparent with this. Even though I'm a business owner, I am the worst freaking bookkeeper on the entire planet. Not because I don't know how to do it, because my mind's somewhere else all the time. So even something that is simple as that, I realize that I cannot be the one doing it. And mine's very simple, but it's like this, right? Like, if you're in the business, you may put off thinking about something like this for so long. But if you have somebody that you're truly working with for tax planning, they're always thinking about this and helping you guide decisions along the way, not at the end of the road, right?
Well, that's the importance of bookkeeping. Think about this, and then we're going to finish up on Section 179. Let's say you try to do your own bookkeeping. You purchase a piece of equipment. Your CPA, your tax professional, your enrolled agent has no idea about the equipment, but they log into your software, your accounting software, and they pull out your profit and loss statement. And on your profit and loss statement, they see an expense that says Chrysler Financial, right? I think Chrysler Financial exists. Um, all of them have, have a subsidiary, right? I don't know if that's eligible Section 179 property. I don't know if it's a lease payment. I don't know if it's a purchase. I don't know how much the cost of the vehicle was. All I see is you put in auto expense Chrysler Financial, which in your mind as a business owner, you're thinking, yeah, that makes sense, right? That's my payment. But from a tax perspective, is it a lease? Is it a purchase? Is there depreciation? Is there personal use percentage? Is it eligible for bonus depreciation? There's a lot. Do we have to do your balance sheet? Did you trade in some other old vehicle and now you have a new vehicle? And even though you're self-admittingly not a good bookkeeper, without being a bookkeeper and understanding how those things affect your balance sheet and the balance sheet affects your tax return, even if you're self-employed, you should have a balance sheet. If your balance sheet's right, your P&L's right. That's an old saying here. So that's a great example of something innocent. You didn't do anything wrong by saying Chrysler Financial is auto expense, because in a business owner's mind, that's what it is. But when we're trying to do tax projections, the first step is have a good set of books so we know what we're doing to project where we're going to be at. So,
And that's another great example you gave there. Honestly, like, it's so simple to most, right? Like, oh, of course I know what it is. My tax professional, of course, is going to know what it is. No, they're looking at hundreds, if not thousands of returns every year. How in the world are they going to know that you went to the dealership on April 27th and traded in a vehicle, which we won't even get into, depreciation recapture. That's one. If you
favorite
people know why
item?
I'm
Yeah.
chuckling is because I dropped that one about 3 months ago and impressed this gentleman right here.
Yes.
But you're right, it's different vantage points at the same thing. However, they all need to align in one way, shape, or form, or you're missing out. It's not even like you're doing anything negligent, right? You're just missing out on huge opportunities for savings.
Right.
Huge, right?
Tying into, like, let's say your Section 179 deduction. We know it's limited to your taxable business income. So what happens, and I've used this strategy on S corp clients many, many times. Let me give you an example. An S corporation, let's say their typical income is about $200,000 a year. Okay. But let's say that once every 4 or 5 years, they need to buy a really big piece of equipment. And that piece of equipment is $800,000. I would like to spread that out and wipe out their income for the next 4 years. Bonus depreciation isn't what I want. I intentionally elect Section 179 on the entire piece of equipment. I can deduct $200,000 in the year it's purchased. The remaining $600,000 of Section 179 just gets carried forward on the business tax return. So I know the next 3 years of $200,000 of profit, I'm going to be wiping it out. So you can use a carry forward to Section 179 strategically in that example. So it's not, everything is situationally dependent, and you have to think about, and for the client that I'm talking about, they would run that equipment into the ground, and there really wasn't a lot of value to it. When after 4 or 5 years, they beat the heck out of it. It was a piece of
Or like take
construction
it to
equipment.
the scrapyard, get your $600 and
Yeah, they scrapped it.
off
They
it up.
got a few dollars, and then we could pay.
Mhm.
So anyway, think about that. So Section 179 does carry forward, and then again, if the asset purchases exceed the phase out limit, meaning the $4 million in 2025, then the deduction is reduced dollar for dollar. And so if you have over $6.5 million worth of purchases in 2025, you will get no Section 179.
And when you say dollar for dollar, I know you explained that, but really, could you explain that just really, really briefly before we close this out? So that cap was it 4 million? I'm so sorry. 4 million
$4
or 4
million,
and a
correct.
So 4 million. So after that 4 million, what does dollar for dollar actually mean for those that may not know
Sure.
exactly what
That means that that for every dollar over 4 million, a dollar Section 179 is phased out. So let's look at an example. Let's say you've got a construction firm. Let's make it easy, and they're a C corporation, so we're not worried about K1s, right? They bought $4.5 million worth of equipment in machinery in 2025. So they bought $4.5 million. The limit's $4 million for 2025. That means they're $500,000 over the phase out amount. Now, typically they can take $2.5 million of Section 179 deduction, right? But because they're $500,000 over the $4 million phase out, we have to reduce their maximum Section 179 deduction by that same $500,000. So their maximum Section 179 is $2 million. And the remaining amount is still depreciated, but just not immediately.
Perfect. Perfect. No, thank you for explaining that. I thought I had an idea what it was. It was pretty close, but I figured it's good to explain that. But no, this was awesome, man. Honestly, this is probably one of my favorite ones that we've done in a very long time.
Well, now
So,
we're gonna get you a sticker that I'm gonna put on your computer. And when you open it up, next time you're at a coffee shop, you're gonna forget about it. And it's gonna say, "Ask me about Section 179."
I'm gonna have all these people coming up to me like, "You don't here, just push play. I'm gonna send you the QR code. You can listen to this podcast. It'll be fantastic." But and no stickers on my computer, sir. It's a Mac. I like wax this thing
I
when I go
know
out.
you.
I
You're
say
very
that because Chris, everybody he's a PC guy, which you guys should be in your industry. You don't want to get too Mac-y. Although I did get you convinced to an iPhone and an Apple Watch. So we'll leave it at that. Uh, Anything else we want to add to this one before we release everybody back to their normal lives?
First, thank you for being part of the Teaching Tax Flow community. If you found this valuable, just subscribe, like, share. The content is driven by you, the Teaching Tax Flow community. And the more interaction we get, the better. We don't charge for this podcast. We don't have upsells for this podcast. We're very blessed to have sponsors that allow us to do this, but we do it for you, the listeners and watchers.
Awesome. It's a good way to end it. So hopefully everybody, you did enjoy this as well. If you're listening to this, don't forget that you can actually watch me and Chris harass each other back and forth. And then when we have a guest, we tend to harass them a little bit on YouTube. So check it out on there. God, we have 650 some odd videos on there. Tons of them. Quick tip reels, usually about 60, 70 seconds, as well as all these podcasts. So check those out. We'll see if we'll be back here again next week on the Teaching Tax Flow podcast. Have a great week.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.